Today is the Friday update. We're going to talk about diversification, dollar cost averaging, and then also something recently that I realized some people don't think about because I had a conversation with someone regarding the fact that if you have money sitting in a checking or savings account and you're receiving a yield, say 5%, that's very different than if you're receiving a yield, even 5%, on something like a stock, and we'll talk about this. Welcome to the channel. This is The Dollar is Dead. I do this 3 days a week. We look at the economics, we look at the markets, and every Friday what I decided to do back in February was I preached that I believe that assets over time are more valuable than dollars. That's what the rich do. I always have to say my disclaimer is not a financial advisor. I just show what I do, informational purposes only. So instead of just saying, look, assets go up in value, dollar goes down in value, there's inflation. Recently, we had a 20-30% jump in a lot of things. They haven't come back down, and they're still on a 3% per year. So if you had money in the bank and you had dollars, you're going to be able to buy less. What do the rich do? They put it into assets. You know cars go up, you know houses go up, you know stocks go up, and that sort of thing. But there are ups and there are downs. That's what we'll get into in a second. So back in February, I decided to track savings accounts, checking accounts, things that are related to the dollar equivalents like a 3-month CD or treasury, and then commodities, gold, silver, then the stock markets, and of course things like the tried and true S&P 500 ETFs, and then more recently things like crypto, Bitcoin, Ethereum, you name it. And then we look at 2-year, 10-year, are we in a recession? Could we be going into one? No one has a crystal ball, but I wanted to be able to point out over time and show how these assets are moving. So today we're going to get into it quickly. So when you're diversifying, you're trying to get multiple assets, hopefully ones that move in opposite directions. So if markets are down in maybe stocks, maybe your gold is up, vice versa. You get the idea. If you look here, the Dow Jones is at 4339. Even though it's down since last week, it's still up from the beginning of the year. Same with S&P 500. Inflation's still around 3%. Unemployment's over 4%. That's not looking great. Here's what I want to talk about today. The very last, well, actually two things. One is the 2-year and the 10-year. You can see here what I've got in the background is it's been inverted, meaning typically if you put money and lock it up for a long period of time, like 10 years, you should be getting a higher interest rate than on a 2-year. Right near now the 10 year is 3.72, the 2 year is 3.7. So you're getting higher, but not by much. For the longest time, it's been inverted, meaning you get more percentage rate on the shorter term, like a 2-year, which doesn't make sense. You should be getting it on the 10. That's called an inversion. When it goes below this black line, which is 0, it's inverted. When it comes out, typically from the past, it's only a matter of time before we go into a recession. That may or may not hold true. But this is something I'm keeping an eye on. It inverted, I think, a week or so ago, re-inverted, and it's teetering around that 0 line, and it could take off. In that case, some of these assets may come down. I don't invest things that I need short term because when things go down, I continue to diversify. I continue to dollar cost average. Now, what I want to point out about interest rates. So here's what I wanted to point out. I alluded to at the beginning of the video. I had a conversation with someone and they talked about a savings account. They said, hey, I just got this bank account. I put some cash in there and they're paying, I think it was 4.5% or 5%. I'm getting 5% on my money. I said, yeah, until you're not. And they're like, what? Well, the bank can change at any time. The Fed is going to have 3 more Fed meetings this year. They may drop rates. They may not. They may. It doesn't directly affect banking rates, but typically it will. So if you're getting 5% and rates start going down, well, then you remember not too long ago, you were getting 1% or 0.5%. Banks can change that on a whim. That's different than if you were to buy, let's say, Verizon at the moment, which may or be 5 or 6%. You buy that stock. You no longer have cash. You have stock in a company. Now that stock can go down in value and you'll lose some capital, or it can go up in value, but it also has a dividend yield, typically paid out quarterly. Can that change? Yes. Usually not as easily and quickly as a bank will change their rates. And it's not necessarily tied to anything like the Federal Reserve rates. If you look online, you'll see the percentage rate change as the price goes up. But you are technically getting that percentage rate at what you buy in. So if you buy it a day and it's at 5%, you're going to be getting 5% on the money you invested. If the price goes up and it shows 3%, you might think, well, now I'm only getting 3%. No, because you bought at a rate that allows you to get 5%. They can change. You can look at the past. You can look up online and see for a particular stock what percentage dividend they gave. And it's actually, it's not a percent. It's an amount of money per share, which works out to be a percent. That's why you're always getting that percentage rate mathematically. So it's not apples to apples. If I wanted to put some long-term money in an investment to pay me a decent rate, I'd be more inclined to buy a stock, which right now there's quite a few that are giving 5, 6, 7, 8%, which I believe are good long-term companies that don't whipsaw too much. And they're providing that rate. And if you look at the past, it hasn't changed all that much. If I threw it in the bank, they could change it like that. So there is a difference between obtaining a yield on money you've invested in something like a stock versus putting it into the bank. They usually have to have a process in which they decide to lower the dividend, and typically it has to have a very good reason, meaning the stock isn't doing all that great, etc. Sometimes they can even stop paying the dividend for a period of time. They can do whatever they want, but it's usually not very fast, and it usually is not tied to things like the Fed rate. So that's what I wanted to point out today. Thank you for watching. I hope this is helpful. At the very least, if you are dollar cost averaging and you are purchasing and diversifying these various things, this is a way for you to keep track of, hey, are we up since the beginning of the year? If you're just watching for the first time, I hope this points out the fact that the dollar goes down in value, assets go up in value. The rich hold on to assets, long-term, not short-term money invested, and consider it because it might be something that will help you, because I'm trying to help people get out of debt and also create wealth for themselves and for their families and their future. Have a great day. Thanks for watching.